Hi, everyone. Welcome to our our weekly workshop, financial workshop. My name is Warren Berger. I'm the founder of Luminary Financial Advisors, and I'm happy that you could join me today. We try to get together every week at 5 p.m. Eastern Time on Sunday to discuss a different financial topic that might be appropriate for your own personal situation and hopefully can add to your own financial wellness. I'm glad that you can make it. And if you have, at the end of this presentation, I'll answer any questions that I can that you may have, and off we go. Before we start, today our topic is where should I put money if I want to save more? So we're always trying to strive to save a bit more money, reduce our expenses where we can. That's always the advice that I try to give people. Makes for a better future. But sometimes it's a question as to where do I want to put this money? What kind of tax advantage buckets might I want to put this into? What kind of financial tools are available for me to save money? So today we're just going to go over a few of those, some of the attributes of those vehicles, and hopefully it's something that you can use in the future. I have to start first with my disclaimer. And that's basically just to let you know that this is for educational purposes only. It's not for accounting or investment or legal advice. It's really hoping that you can take some information away from here, see if it applies to your own personal situation, and then run it by the professionals in your life, your financial advisor, your attorney, or your CPA to see if it's an actual fit for you. So just keep that in mind as we go forward. So I'm going to start out today with what I think is really the basic thing that everyone needs to have, and that's the foundational savings. And what I mean by foundational savings is really talking about an emergency fund. I think it's the first place to start when you're thinking about saving, and it just makes a lot of sense, right? What happens in the event that you lose your job? What happens in the event that you have an unforeseen expense that you haven't been budgeting for? Where's that money going to come from? And I think all too often people find themselves in a situation where they haven't put this money aside for emergencies, and they end up in a position where they have to scramble, either putting things on credit cards or taking money from investment accounts that they weren't planning on that may or may not have some tax implications there as well. So a couple of just rules of thumb that I think that you can look at when it comes to an emergency fund. If you're married and both you and your spouse are employed, 3 months worth of living expenses is generally going to be okay. If one person loses a job, you still have someone else that's working. And like I said, these are just rules of thumb. It really it goes to your comfort level. But these are things that we've just seen in the past that really make sense for people. If you're single or you're the sole income earner for your family, we talk about really having something closer to 6 months of money set aside. And that's because we don't have that backstop of another salary coming in. And in the event that the one earner is out of work, we're really going to be putting a lot of pressure on the family situation. So, and then for high income earners or entrepreneurs, we actually recommend having 18 months worth of really emergency savings, but I like to call it dry powder. So if you're an entrepreneur or you're a high earner, number one, you can afford to have a bit more money put aside, but also you might be in a position where certain opportunities are going to come your way, whether they're business opportunities, investment opportunities, where you might want to have access to cash that you don't want to be reaching into certain investment accounts for that because it might be an inopportune time from a tax perspective or even from the market perspective. We don't want to be diving into investment accounts when markets are down. So just a couple of things to think about when it comes to setting up your emergency fund. The next series of saving we talk about is healthcare savings. So, all of these things are just different vehicles, different ways to think about putting your money into separate areas of your life. They all have a distinct purpose. And so you need to evaluate what is that purpose, what are you going to end up using these funds for, and then just adjust it accordingly. So when it comes to healthcare expenses, the first thing we talk about is the flexible savings account. So you can make a tax-deductible contribution for $2,750 to be used for medical, dental, and vision care. The thing with the FSAs, and I've actually been caught on this in the past in my previous career. If you don't use the money by the end of the year, you lose it. Some companies do offer a grace period at the end of the year to use it, and some companies also offer up to $550 of funds that they'll allow to be carried over. But it's really up to your company. And most companies will lose it if you don't use it in that year. The next health savings vehicle is the health savings account, and this is the most, when it comes to saving, and we talk about 401k and we tax deferred money, the most tax efficient account that you can save money into, and it's something, if you do have access to it, it really should be something to be considered, is the health savings account. And so a health savings account, you can contribute $3,600 for an individual or $7,200 for a family. And if you're over 55, an additional $1,000 into it. And so this is what's called triple tax advantaged. So the way a health savings account works is that the money that you put into the HSA is tax free when you put it in. It grows tax free. And if you take the money out for health expenses, you are not taxed on that money coming out. So it's that triple tax advantage that makes this a really powerful tool. And what we find is that when we look at retirement accounts, an HSA can be an important vehicle in retirement because we do have an increase in healthcare costs. So saving for those healthcare costs and being able to use that in this tax advantaged way really adds up to a lot of savings. And these health savings accounts are investable. So you can be investing in the markets, capitalizing on compounding over time with the markets to be able to save up a sizable medical fund for when you do reach retirement. And especially as you get towards the latter stages of retirement, where we start to get into long-term care costs, they can really balloon. And so the HSA is something to really take into consideration. There's a couple caveats to being able to having access to an HSA. And that's that you have to have a high deductible plan. The deductible has to be at least $1,400 for individuals and $2,800 for families. And it has to be an HSA eligible plan. You have to have maximum out-of-pocket costs of $14,000 for families and $7,000 for individuals. So just keep that in mind. Very powerful tool, probably the most tax efficient tool that there is out there. So now we're talking about retirement savings, and this is the crux of where a lot of people, this is what people think about when they talk about savings for the most part. And a lot of us do have retirement plans that are offered through our employer, and it's just a couple of ways to look at it. We definitely want to be saving into a tax-deferred vehicle if we can. Certainly enough, if you have an employer match for your retirement savings, I've seen matches up to 7%. That's essentially free money. That is your employer matching the savings that you put into your either 401k or 403b, whatever applies to you. And essentially, that is an employer giving you free money. It's an added benefit that you deserve as part of your compensation, and if you're not taking advantage of that, in a lot of situations, that would be a mistake. So you want to at least start out by contributing up to that match. You can contribute up to $19,500 annually. If you're 50 and over, you can contribute up to $26,000 into a contribution plan. Now, if you've made the maximum salary deferral contribution, you've hit your $19,500 or your $26,000, there is a way to do some additional contributions called a mega backdoor Roth contribution. I will be talking about that in a future workshop, but just know that there is another vehicle out there to have additional savings. It's a bit more complex into how that works, and so it sort of deserves its own time, I think, if we're going to get into that. If you think that your income is going to be rising in the future, you definitely want to consider contributing to a Roth 401k. And essentially, the Roth vehicle is if you believe that you're going to have a higher income tax base in the future. then saving into a Roth vehicle, which is a tax-free vehicle when it comes out, might be really appropriate for you. For a Roth IRA, you can contribute up to $6,000 a year or $7,000 if you're 50 or over. But there is eligibility phase outs for that, depending on how much you earn. It's between $125,000 and $140,000 of your modified adjusted gross income if you're single, and it's between $198,000 and $208,000 of your MAGI if you're married filing jointly. And essentially, what that means is once you hit the bottom of that phase out, the amount that you're able to save into that account is reduced accordingly up until the point that you reach the max, at which point you can't contribute to that retirement vehicle. So just keep that in mind. Now, if you have a MAGI that's greater than $140,000 or $208,000 if you're married filing jointly, and you've maxed out your 401k salary, if you want to save some more, you can consider doing a backdoor Roth, and you could save an extra $6,000 into a Roth IRA account, $7,000 if it's over 50. And essentially, what that is the backdoor Roth is you're setting up a traditional IRA, which normally, if you're below certain account thresholds, you would be able to have a tax deduction for your traditional IRA. But in this case, because you can't have a deduction for the traditional IRA, you have what's called a non-deductible IRA, which means you're putting after-tax money into that IRA. You would take the traditional IRA that you've contributed to, and you would roll that over into a Roth IRA, and then pay any of the capital gains taxes that are due on any of the earnings that you've made in between setting up the traditional IRA and doing that rollover. There are definitely a few other factors to consider when doing this. Don't just go out and do it. Really talk to your financial professional that's in your life, your CPA or your financial advisor, to know just a couple of the nuances that are involved in doing it. This is more to just really let you know that these vehicles are out there and that you can take advantage of them. But like I said, make sure you're running it by your financial professional. Let's talk a little bit about college savings. Depending on where you're at in your life, you may have already been saving for college. You may be just starting, but you might want to consider a 529 plan. I think a lot of people have probably heard of this. One of the things that I think is interesting about the 529 is that you can use your annual exclusion to contribute up to $15,000 per year, and you can do that gift tax free. So it's just something, a lot of times grandparents will use this to contribute to their grandchildren's college fund. It's a great way for them to be able to do it and not have it affect their gift tax. And rather than doing just the $15,000 per year, you can also do a one-time lump sum of $75,000, and then you can essentially make you can elect to treat that as though it was given a $15,000 a year over a 5-year period. So it's just something to keep in mind. And like I said, a lot of times we see that with grandparents that want to help contribute to a grandchild's education. Also with the 529, you might be eligible for state income tax deduction or credits if you're contributing to a plan that's sponsored by your state. And that's going to be different from state to state. So tax deferred insurance, that's our next topic. A little bit trickier. It's generally a little bit lower on my list of places that I like to see people but save money. But a lot of these, if you've sort of maxed out some of these avenues that we've talked about and you still have money that you're looking to put away, we're looking for any place that we can actually achieve some sort of tax mitigation. And so you can consider an annuity. Some people are dead set against them. Annuities can have their place. The one thing that you have to understand with an annuity is that depending on where you're getting it from, there could be some substantial internal costs involved in the annuity, which actually takes away from any of the benefits that you may gain. So you really have to evaluate each annuity for what it's providing, as well as the annuity provider themselves, to see if it's up to snuff in terms of being able to give you that, maximize that tax advantage while not getting subsumed by the internal costs. And now some of these tax deferred annuities, because when you're in an annuity, it will grow tax deferred, and that's an attractive thing, especially as you're looking for avenues for tax deferral. And you can find contracts that will offer less of a guarantee on the annuity side of things. And that becomes a lower cost option and really becomes more of a vehicle for exploring the tax deferral mechanism within the annuity. But like I said, each one of these has to be considered in its own right, especially the internal costs involved in the annuity, and should be run by your financial professional as well. You can also, if you're thinking that you might need to increase life insurance, you could look at some of the benefits of buying a cash value life insurance policy, where you can get both the life insurance pledge that you need and then have some tax deferral gains that are there as well. Once again, same thing, internal costs that are involved, and whether it's appropriate for your personal situation. Really make sure you're running this by your financial professional. But these are other options for tax deferral places to save money. So now just some of the other accounts to think about. Excuse me. And that's really once you've exhausted your ability to save into sort of tax deferred or tax free accounts, your last sort of bastion for saving is really a taxable account. And that's really what we refer to as your general brokerage account, where you're buying stocks or mutual funds or electronically traded funds. And the long-term gains on the sale are taxed at preferential rates. You do want to be careful about selling short-term capital gains that can be accrued in these taxable accounts, anything less than a year. Those are taxed at ordinary income, and so that can be a substantial tax burden when you factor in short-term capital gains. But long-term capital gains are taxed at preferential rates, as well as qualified dividends are taxed at preferential rates as well. So a taxable account is actually can be quite tax efficient, especially when you invest in certain types of funds or zero dividend stock funds, municipal bond funds, or ETFs that can help further mitigate that tax liability within that taxable account. And so often what we do as we get closer to retirement, we really start to look at the different tax accounts and sort of the income streams that we're going to derive in retirement, and what is the most strategic way that we can take money out of those accounts. And ultimately, you look at either a tax-deferred account, a tax-free account like a Roth, or a taxable account like these investable accounts that we're talking about. And depending on where you are in your retirement, there are strategic and tax mitigation thresholds that can be used to strategically take money from these accounts. Those also should be talked with your financial advisor and your CPA to see what makes the most sense for your personal situation. Another thing, if you're charitably inclined, is that you can consider using a donor-advised fund, where essentially you're able to contribute to a charity by essentially setting up a fund, and that fund distributes to the charities over time. It can set you up for a situation where you could double up on your deductions for a given year, so that you're over and above the single deduction, and then allow those donor advised funds to go out where they need to go. So it's just another thing to think about. Obviously, if you need assistance in creating a retirement plan or a Social Security plan, or talk about retirement distribution or tax mitigation efforts, we'd love to help you. I've had, if you go to luminaryfinancialadvisors.com/get in touch, you can schedule a complimentary call. We talk about financial problems or questions people might have and see if we're a fit to work together. And if we're not a fit, we'll always make sure that we're referring you on to somebody that can help, or at least set you off in a direction where you can go and help yourself. So that's really, we try to work from that frame, and hopefully that any interaction that people have with us, they come away feeling as though they've been helped. So that's basically it in terms of the different savings vehicles. There are more that are out there, but I think that that's a good place to start for people to start doing their own investigation And let's take a look and see. It looks like we have a couple of questions here, so let's see what we can do. So can I pay insurance premiums from an FSA or an HSA? Great question. You cannot pay your insurance premiums from an FSA or HSA. You can. There's two exceptions to that actually. From an HSA, you are able to pay premiums for if you're on COBRA, if you've been separated from your job and you're on COBRA, or you're on unemployment. Those are really the two times that you'd be able to pay premiums. Otherwise, you are able to pay co-payments or any actual medical payments that need to be made can be made from those accounts. Premiums, no, except for those two caveats. Another question: what is MAGI? Okay. Big conversation, but in brief, MAGI is your modified adjusted gross income. And essentially, it's an important figure because the government uses that to ascertain whether or not you're eligible for certain either tax benefits or certain benefits or retirement accounts. For instance, your IRA accounts, whether they're tax deductible or whether you're able to actually contribute to a Roth IRA. We talked about some of those limitations earlier. And then also when it comes to Medicare, your Medicare premiums are going to be based on your modified adjusted gross income. And essentially what that is it's your adjusted gross income. So the deductions that you've made from your income, you end up coming up with your adjusted gross income. And then for the MAGI, they add back in certain tax exempt interest and certain deductions that get added back into MAGI. And you're not going to find that on your tax return. You actually have to do a couple of calculations and to get there. It's a really important number to know, especially as you near retirement and especially as it applies to income as it relates to Medicare. So another great question. So that's all we have for questions right now. I hope that you found this helpful. I have included a link to my personal calendar in the comments section. So if you would like to schedule a complimentary retirement call, I'd love to hear from you. And hopefully we get to see you next week. We'll be doing this again on Sunday at 5 p.m. Eastern. And have a great weekend.